Hey, what's up guys? Welcome back to Smart Wallet and Me, where financial wisdom matters. I want to wish all of you a very Merry Christmas and a Happy New Year. In today's video, I'm going to be talking about US investors' risk in Chinese stocks and what this means for us as US investors and buying Chinese companies. So let's get right into it. Okay guys, so first off, I want to start off with the new law that just came out, the S.945 bill, the Holding Foreign Companies Accountable Act. This bill passed by the House, the Senate, and by the President on December 18th, and it is now law. So now this bill became a law, and it requires certain issuers of securities to establish that they are not owned or controlled by a foreign government. Specifically, an issuer must make this certification if the PCAOB is unable to audit specified reports because the issuer has retained a foreign public accounting firm not subject to inspection by the board. Furthermore, if the board is unable to inspect the issuer's public accounting firm for 3 consecutive years, the issuer's securities are banned from trade on a national exchange or through other methods. So guys, now this bill has passed unanimously by the Senate, and it has passed the House, and it has been signed by the President. It is now law. So this means that these foreign countries, specifically China, that this law targets, needs to make sure that these companies that are traded on US exchanges need to be audited by accounting firms that is also under the scrutiny of the PCAOB, or the Public Company Accounting Oversight Board. A lot of people have told me that don't worry because these companies that are on the US exchanges have complied, they're fine, don't worry about them. Now that may be true, but when I read the article here on the PCAOB website, it says public companies that are audit clients of PCAOB registered firms from non-US jurisdictions where the PCAOB is denied access to conduct inspections. So you got to do your own due diligence whenever you're dealing with investments like this. You don't want to just listen to some random YouTuber or some random person telling you, yeah, everything is good, everything is fine. You got to do your own due diligence and do your own research because you're dealing with your own investments, with your own money. And again, don't even take my word for it. Go do your own research. I'm not a financial advisor. I'm not an attorney. I'm not telling you what to do and what not to do. However, based on the information that I am seeing right now, and I'm going to be sharing it with you so that you can ultimately make your own decision and you can take the tolerance level that you feel is conducive to you. And for me, if I'm not going to be able to sleep comfortably by investing in these Chinese stocks, then I will sell them. But if you have the risk tolerance and are able to sleep comfortably at nighttime, then by all means you should be investing in Chinese stocks. However, I just want to make sure that the buyer is aware that there are some risk involved when you invest in these Chinese companies, and I just want to get the information out there so you can make the smart choice for yourself. Without further ado, let's go ahead and see what this article is saying here. In order for their securities to be traded in US capital markets, public companies, whether located in the US or abroad, must comply with certain US legal requirements, including the requirement to periodically file audited financial statements with the US Securities and Exchange Commission as required by the Sarbanes-Oxley Act of 2002. The auditor of those financial statements, whether a US auditor or a non-US auditor, must be registered with and therefore subject to the jurisdiction of the PCAOB. This includes undergoing regular PCAOB inspections to assess the auditor's compliance with US law and professional standards in connection with its audits of public companies. So as we go further down, you can read here the list of public companies affected by obstacles to PCAOB inspections. For those of you who were saying that these Chinese companies aren't compliant and they have been audited and everything is fine and everything is dandy, well, let's take a look if that's really true or not. Positions taken by Chinese authorities impede our ability to oversee PCAOB registered audit firms in mainland China and Hong Kong. Specifically, these positions currently impair our ability to conduct inspections of the audits of public companies with China-based operations. So, in addition, the PCAOB currently faces obstacles to inspect PCAOB registered firms in 2 European Union member states. However, we expect to conclude soon bilateral cooperative arrangements. So this is dealing with Europe. So we're not really going to be dealing with Europe because we want to deal with the US specifically for my video. So if we go further down, I'm going to show you some of the list of companies that are denying the auditors from conducting their audits to the PCAOB. So if we go down here, you can see all the list of these companies. And the big one that I want to show you guys right here is Alibaba Group Holding Limited, denied issuer audit client. And the auditor name was PricewaterhouseCoopers and in Hong Kong. You can also go down and see here, they also have Baidu, denied issuer audit client, Ernst & Young Huaiming LLP in China. And then we can see here Li Auto. We have Neo Inc., denied issuer audit client, PricewaterhouseCoopers Zhongtian. And then we have here Xpeng, PricewaterhouseCoopers Zhongtian LLP in China, denied issuer audit client. So what does this mean that all these companies are denying the issuer audit client? Means that these companies are not allowing or are not complying with the PCAOB requirements to have these auditors come to audit their records. And because of that, these companies are risking of being delisted from US exchanges. So unless these companies start complying with the US request, there's a big risk for them to be considered non-compliant and therefore be delisted from US exchanges. And if you go over here to the PCAOB website and look at their oversight and look at their auditing standards, they have approximately 700 something pages to comply by. These are the auditing standards, 725 pages of auditing standards of the Public Company Accounting Oversight Board. This is based on the financial statements for fiscal years ending December 15, 2017 through December 14, 2020. So now the time clock starts clicking from the time that this was issued or signed into law from December 18, 2020. These companies have approximately 3 years to comply to this law. So they need to be compliant 3 consecutive years. And if they don't, they risk being delisted from US exchanges. And we just saw what are those companies that are denying the auditors from accessing the records to comply. Now, does this mean that they're going to be non-compliant forever? I highly doubt it, because they're risking $2.2 trillion in market cap. So I would think that the Chinese regulators would be foolish to actually go along with that and put in laws in place to deny the auditors from actually complying to these auditing standards. But that's just my opinion. I don't know what the Chinese Communist Party is going to do. They have their own laws, they have their own way of doing things, and obviously they need to make their own decisions. However, we as American investors need to be aware of the risks involved and make sure that we have the proper information in our hands to make the wisest and smartest choices possible. Another very important thing that I want to talk about was that these Chinese companies are VIEs, or variable interest entities. And basically what this means that there's a shell company usually that is put in place in a country like the British Virgin Islands or the Cayman Islands as a shell, where you only buy contracts of the shares in China. You're not actually buying equity inside of Alibaba or in Neo or Li Auto. You're actually buying a contract that has really no equity in it. And this is very dangerous, because a shareholder could not have any kind of right into making a decision inside of the company. You're basically just holding a contract, and those who are actually inside of the Chinese company have the actual power to make those kinds of decisions, whereas you as an American investor do not have that power or that authority. So a V entity is an entity controlled by a company by means other than a majority of voting rights. So this was written in 2017, and I think there's more than 20 companies that are considered V structured companies. But for the sake of this video, we can see here that Alibaba, because they came out in 2014 in an IPO, they are a VIE structured company. So some companies that went public earlier with VIE structures, notably Sina, Alibaba, and Baidu, have reached enormous valuations, with Alibaba racing neck and neck with Amazon to receive or to achieve a 500 billion market cap. So some of the risks that are involved with V's is right here, where it says that, but VIEs are fraught with complexity and risk for investors, including vulnerability to Chinese government pressures and management conflicts of interest. And we can see that happening right now as we speak with Alibaba, with the Chinese government clamping down on Jack Ma with anti-monopolistic investigations, which is a very good thing. And this might be one of the reasons why the Chinese government is actually clamping down on these companies. They might be showing their due diligence and their interest to try to comply, to show the American investors that they're doing something to make sure that these companies are not breaking the law. I believe that might be a possibility, that they are actually showing the foreign investors that the Chinese government is doing things to prohibit anti-monopolistic activity, and they're trying to make good on their promise. But it could also cause risk to the US investor because their shares can drop. The V structure could be deemed to contravene Chinese laws that restrict foreign investment in strategically sensitive industries. VIEs operate using contractual arrangements rather than direct ownership, leaving foreign investors without the rights to residual profits or control over the company's management that they would otherwise enjoy through equity ownership. So basically it comes down to ownership and what you can actually do as a US investor, whereas you're just basically held hostage based on what the government does to these companies and what the people and management inside of those companies decide to do. And another thing I wanted to bring to your attention as well is this article that I saw on the Financial Times called Trump Team Outlines Plan to Crack Down on US Listed Chinese Groups. And we could see here that the proposals announced by a working group that included Steven Mnuchin, the Treasury Secretary, and Jay Clayton, the Chairman of the Securities and Exchange Commission, would force Chinese companies to delist from US stock exchanges unless regulators get access to their audits. And we just saw that a lot of these companies are not gaining access to their audit records and their accounting records because they're denying them. President Donald Trump in June gave his team 60 days to come up with their recommendations, and their release on Thursday marks another point of growing friction between the US and China as relations between the countries plummet to their lowest point in decades. The measures, which are subject to a lengthy rulemaking process before going into effect, would force the delisting of Chinese companies audited by firms whose work cannot be reviewed by the US Public Company Accounting Oversight Board because of Chinese government restrictions. The PCAOB has for years been unable to review audits of China-based companies that are listed on US exchanges. The Chinese government prohibits the US regulator from inspecting auditing firms in the country and bans sharing internal audit documents. The Trump administration recommendations envision an alternative to delisting in which the companies could hire a co-auditor outside of China, potentially a US-based entity, within the same auditor group, thereby allowing the PCAOB another means to review the audit. Now, they're trying to create a different recommendation. We will have to see if this is going to be implemented or not, but I would think it would be in the Chinese best interest to have these records be inspected by the auditors, because otherwise, like I said, they will lose $2.2 trillion in market cap. Now, this is what I found very interesting that I wanted to highlight. And this article says that the proposal recommends delisting companies that fail to comply with either requirement by January 1, 2022, and a ban on new listings that did not comply, which would kick in immediately. If they come into compliance, there would be very little impact, said a senior SEC official. With zero compliance, I think you'd have a fairly significant impact. So guys, how do I interpret this and what would I do for myself? Just for my own personal sake, I have a small portion of my investments in Alibaba and Tencent, and I'm going to continue to hold my positions personally because my positions are not a very large position. However, I do like the fact that these companies are very strong. They seem to have a very large revenue source, and they have a very large market cap like Amazon does in China. So I do believe that they are very strongly positioned. However, because of the political situation and because we cannot really dictate or control what the Chinese government is going to be doing, there's a very high risk involved when investing in these Chinese companies. Therefore, I'm only investing the amount of money that I'm willing to lose. And you guys should be able to make that choice and that decision on your own. I'm not telling you what to do. I'm just sharing the information. I know some people will not like this video and they will give it a thumbs down. But I'm asking you if you could please give me a thumbs up and let this video go out to other people so they can see it as well and make the choice for themselves. I also saw the article here from the SEC.gov website that says that risk related to the regulatory environment, China's legal system is substantially different from the legal system in the United States and may raise risks and uncertainties concerning the intent, effect, and enforcement of its laws, rules, and regulations, including those that restrict the inflow and outflow of foreign capital or provide the Chinese government with significant authority to exert influence on a China-based issuer's ability to conduct business or raise capital. And it says, going down, it says, in the absence of required permits or licenses, governmental authorities may impose material sanctions or penalties on the company. And that's what we're seeing right now with Alibaba with their investigations. And they could bring a lot of risk for US investors. So we can see here on the chart for Alibaba, this company lost $34.18 on the last trading day, which was yesterday, and it now is trading at $222. And this was my support line that I drew in my previous video, and this was the support that I had put in, and I said that this was going to be a wedge and it could go higher from here or lower. But because we saw on the 4-hour chart that this has actually broken down, and the 50-day moving average has gone across the 200-day moving average, we are now in bear territory. And also because on October 27 we hit the high of $317, and right now we're at $222, we are basically 43% below the highs. And based on the experts, they say that when a stock is down 20%, we are in a bearish mode. And according to that standard, this company is now in bearish territory. And we would have to wait and see if this is going to actually turn back around and go over this threshold and support lines. And if it doesn't, in my previous calls, I mentioned that we have support around the $200 mark, which is right around here. And if that doesn't hold, then we can be going down to the March lows of approximately 185. So that is my take on this, and this is my risk that is involved in trading in Chinese companies. You need to take your own risk and your own tolerance level. Of course, there's a lot of risk involved with any company, but there's extra risk involved when you're trading with Chinese companies, especially like Alibaba and Baidu, Tencent, and even Neo and Xpeng and Li Auto and these other types of companies. There are over 200 companies that are exchanged on the US exchanges from China. So guys, that's all I have for you. I know this is a little longer video than my usual one. I hope you guys like this video and give me a thumbs up. I would greatly appreciate it, and I'll see you guys in my next video. Thanks for watching.